5-year fixed mortgage rates are plummeting on fears of a looming recession and reports that inflation has peaked. But just how low will they go? Well, we're going to get into all of that. But before we do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our Secrets to Getting the Lowest Interest Rate course and our home buyer boot camps, both of which are priced so low that you will get at least 10 to 50 times your money back just by being informed and having the information that's available in both of those courses. So if you want to know how to negotiate with your broker, how to negotiate with your bank, how to save a ton of money without stepping on landmines and surprises that come along with discount mortgages, that course is for you. Go to ratesecrets.ca and check them both out. All right, so let's get into it. Consider this your mid-month mortgage rate update for July, because as I suggested in the beginning of this video, interest rates are coming down. Fixed rates mortgages are coming down almost as fast as they went up in March. The reason for this is bond yields are starting to tank. And there's really good reason for that. And I'm going to get into all the details. And at the end, I'm going to explain exactly what interest rates are today and where you may want to look as far as getting a mortgage right now. So I'm going to jump you in first and foremost to the headlines here. Take a look at the Canada 5-year government bond yield. This is the bond yield that 5-year fixed mortgage rates are priced off of. And as many of you know, if you've been watching this channel, in the middle of June, these bond yields got up to about 3.6%, which is the highest they've been since 2008. And you can see the peak here. This is when 5-year fixed rates basically got to 5.25%. And over the last month, basically what's happened is these rates have consistently come down and they've now reached a low of 2.88%, which is almost back to the levels they were at in early June and mid-May. Now, what's the reason for this? Well, there's a whole bunch of reasons, but basically it's two things. One is it seems that inflation may have peaked, and two is that there are fears of a recession looming and the bond market is pricing that in. So basically what the bond yields are telling us is that over the short term, we're probably going to see a few more interest rate increases from the Bank of Canada, but we're nearing the end of that cycle. So I want to take you in and show you some of the other headlines here. First and foremost, this is from CTV News. Canada recession, it's coming, RBC predicts, but how long will the downturn last? Some are predicting it will be an extensive downturn. Some are predicting that it will be a soft landing. Only time will tell, but it looks as though with certainty, both in the US and in Canada, that the central banks are going to have to break the economy in order to break inflation. And it looks as though inflation is going to last well into the end of the year. Now, moving on from there, looking at Canada's inflation rate, there were several reports this last week that Canada's inflation is peaking. In other words, we are hitting the tops. We are seeing less upward price pressure on food. This is particularly as Kiev and Moscow agreed to a deal to resume Ukraine grain exports, which led to grain prices coming down to the lowest they've been since the beginning of the Russia-Ukraine conflict. Then we've got lumber prices have come down significantly as interest rates go up and the real estate market cools. In fact, lumber has come down to pre-pandemic price levels. So when we had all of this run up of lumber prices and the expected impact that that was going to have on the housing market and building costs and so on and so forth, well, we are now back to pre-pandemic lumber prices, which is a pretty good sign with respect to inflation. And then last but not least, one of the biggest stories with respect to the inflation numbers and the supply chain issues is that West Coast ports are reducing idling vessels as container supply increases. The queue of waiting vessels in the Port of Los Angeles, for example, is down 80%. And this is largely due to an increase in supply of containers and these supply chain issues working themselves out. So this is all good signs for inflation. And with good signs for inflation comes good signs for interest rates. As we've seen, basically 5-year fixed rates come down to 4.79%, and there's significantly more room for lenders to decrease those interest rates. Now, to put that in perspective, a 5-year variable rate mortgage right now, or an adjustable rate mortgage, is going for about 3.8%, so about 1% lower, but these rates are starting to come closer and closer together. Now, you can rest assured that the Bank of Canada is going to increase interest rates in some way, shape, or form in September. Many economists are predicting that the Bank of Canada will increase interest rates to 3.25%, which is 1% higher than where we are at right now, at least by the end of the year. But with bond yields starting to settle down, that's telling us that the expectation of higher rates is starting to go away. And as those interest rates start to come together, well, that could be a good opportunity for people to lock in. Now, one thing to keep in mind here is the yield curve, which is showing us some really interesting data right now. If you take a look at the yield curve, what we look for here with respect to locking in is we tend to look for 2-year rates to be well below 5-year rates and well in line with what variable rates are. And as you can see from the blue line, which is last year, there was a significant difference between 5-year and 2-year rates. Right now, which is the black line, you can see that 2-year rates are substantially higher than 5-year rates. Well, as rates begin to normalize, we should start to see the 2-year rates come down well below the 5-year rates, and the 2 and the 3-year options tend to be the best options down the road with respect to locking in. Now, we've got to wait for those rates to drop, and at some point, the yield curve will stop being inverted, and there will be an opportunity to lock in at short-term rates, but we've just got to wait for that to happen if you're in that variable rate scenario. So this is all really good news for interest rates. It tells us that we're coming to the beginning of the end of the rate increases, at least hopefully. Now, these rates could spike up again tomorrow. We could see expectations that inflation is going to continue to increase, go up again, and this could cause the 5-year bond yields to spike again. But for the most part, as of right now, as of the time that we're filming this, it seems to be the case that there's some relief in sight with respect to interest rates. And I think for Canadians, that's really, really, really good news. Hopefully, we'll remain flat for the next little while, maybe start to see those fixed rates come down even further. There's definitely some room for banks and what we call the A+ lenders, which are the non-bank lenders, to reduce their interest rates even further than they already have. I could see 4.5% by the end of the month on a 5-year fix, which would be a great rate. And hopefully those rates remain around that 4.5% level for the extended future. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video, and we'll see you on the very next one. Cheers.